we're going to be addressing fixed manufacturing overhead variances. Recall that cost behavior describes how costs change with changes in the level of activity. The level of activity, also known as the cost driver or activity base, is what causes a cost to change. Cost drivers may be any number of things, such as units produced, direct labor hours, or machine hours, to name just a few. Fixed costs, however, do not change with the level of activity. Activities may increase or decrease, but fixed costs, at least within the relevant range, remain constant. For example, consider rent paid for factory space. Regardless of whether the company produces 0, 2, 50, or 100 units, the total rent paid remains $9,000. However, fixed overhead costs are still one of the main product costs. Unlike direct materials and direct labor, which are directly traceable to the product, both variable and fixed manufacturing overhead costs are indirect costs, which must be allocated to the cost of the product using a predetermined overhead rate. This rate is calculated by dividing the estimated annual overhead costs by the estimated annual activity base for both variable and fixed overhead. Once a predetermined overhead rate is calculated, it's multiplied by the actual activity base used in the manufacturing of the product. This allows us to determine the amount of overhead to assign to each product. Why is this important to understand with regards to the fixed overhead variances? Well, it's because it'll help you understand why these variances are being calculated. First, fixed overhead costs do not change with the level of activity, so the fixed overhead spending variance is the difference between the total actual fixed overhead costs and the master budget's total fixed overhead at the original level of activity. Why? Because fixed costs don't change with the level of activity, so there should be no change between the actual fixed overhead costs and the budgeted fixed overhead costs in the original master budget at the original level of activity. The fixed overhead spending variance shows if the spending on fixed overhead is under or over budget by comparing the actual spending to the original budget's prediction of what will be spent. Second, the fixed overhead volume variance, sometimes called the production volume variance, is the difference between the actual volume produced and the estimated volume for the master budget. It tells the organization if the company produced the same volume as originally budgeted, or if the actual volume produced was higher or lower. It determines if the organization effectively utilized the fixed capacity of the factory, or if they wasted it by producing less than was budgeted. We calculate the fixed overhead variances using a formula. We'll start on the left side by calculating the total actual fixed overhead. This is calculated as the actual units produced multiplied by the actual activity base per unit multiplied by the actual application rate. This is almost always given in a question as a single amount, the total actual fixed overhead, but it's still a good idea to know how to calculate it. Now, in order to calculate the fixed overhead spending variance, we have to compare the actual fixed overhead to the master budget, also called the static budget, for fixed overhead. Sometimes you're simply given the total amount of fixed overhead from the budget, but if you are asked to calculate it, you would have to take the master budget's total units and multiply it by the standard activity base per unit and multiply it by the standard application rate. Basically, this formula is calculating the estimated annual overhead costs. Now, in order to calculate the fixed overhead spending variance, we have to compare the actual fixed overhead to the master budget's fixed overhead. This variance will tell us whether we've spent more or less than what was budgeted. Now that we understand how to calculate the fixed overhead spending variance, let's move on and calculate the fixed overhead volume variance. Remember that we have to compare the actual production level to the master budget predicted production level to determine if the factory's capacity has been used efficiently. We already have the master budget production level. It's represented by the master budget calculation in the center. In order to calculate the fixed overhead volume variance, we need to add the concept of the applied fixed overhead. Remember that in order to apply fixed overhead to the cost of the product, we take the predetermined overhead rate, which is calculated as budgeted fixed overhead divided by the budgeted activity base, and we multiply it by the actual activity base used in actual production. This allows us to calculate the total fixed overhead to apply to the product. We can add that into our fixed overhead variance formula as an additional calculation on the right. This will allow us to take the actual units produced and multiply by the standards. Therefore, the total fixed overhead applied is the actual units produced multiplied by the standard activity base per unit multiplied by the standard application rate. By comparing the total fixed overhead at the master budget's volume level, which is the center calculation, and the applied fixed overhead at the actual level of production, the far right calculation, we can determine the fixed overhead volume variance. Notice that between these two calculations, only the number of units changes. It's clear that we are comparing how many units we were supposed to produce, the master budget units, and the number of units we actually produced. Remember, this is a measure of how efficiently management has used the fixed capacity in the factory. If actual units are greater than the budgeted units, they effectively utilize their fixed capacity at the factory. On the other hand, if the actual units are lower than the budgeted units, then they were inefficient in their use of the factory capacity. Now that we understand how to calculate the fixed overhead volume variance, what about the total fixed overhead variance? How is that calculated? The total fixed overhead variance is equal to the fixed overhead spending variance plus the fixed overhead volume variance. This is shown in our formula as the difference between the first amount calculated on the left and the last amount calculated on the right. It can also be determined by simply adding the two variances together. Let's use an example to demonstrate the calculation of all of these variances. Kira Inc. applies overhead on the basis of direct labor hours, meaning that this is their activity base. The company has the following standards: standard application rate of $12 per direct labor hour and the standard direct labor hours of 4 hours per unit. The company has the following actuals. Total actual fixed overhead is $410,850 and actual total direct labor hours is 35,273 hours. Budgeted production was 8,000 units and the actual production was 8,300 units. Calculate the fixed overhead variances, both the spending and the volume variance. We'll apply the information from the question to the formula. Starting on the left, the actual units produced multiplied by the actual activity base per unit multiplied by the actual application rate is equal to the total actual fixed overhead. We already have that information in the question. Total actual fixed overhead is $410,850, so we can simply add this into the formula without any calculations. We've placed $410,850 all the way on the left. We now move to the center calculation, which is the master budget. For that, we need the budgeted units, budgeted activity base per unit, and the standard application rate, and we can get all of that information from the question. The budgeted units are the budgeted production of 8,000 units. We know that the fixed overhead is applied on the basis of direct labor hours, which is our activity base. So, the standard activity base per unit is equal to 4 hours. Finally, we also need the standard application rate, which is $12 per direct labor hour. We have everything to calculate the master budget's fixed overhead, so we'll transfer the information into our formula. 8,000 units multiplied by 4 direct labor hours per unit multiplied by $12 per direct labor hour is equal to $384,000. This is the total fixed overhead that is included in the master budget. We can now compare the actuals on the left to the master budget, the center calculation, which allows us to determine the fixed overhead spending variance. The difference between $410,850 and $384,000 is $26,850. Now, is this variance favorable, meaning it's good for the company, or unfavorable, bad for the company? We can clearly see that the company actually spent $410,850, but according to the master budget, they should have only spent $384,000. This means the company spent more than they should have based on the standards, and the variance is therefore unfavorable, denoted with a U. The company didn't do a good job controlling their fixed overhead costs during the period. Remember, the fixed overhead should not change with the level of activity, so the difference between the actual fixed overhead and the budgeted fixed overhead isn't due to the difference in the actual production, 8,300 units, and the budgeted production of 8,000 units. Instead, This variance is due to the difference in our spending, how much we incurred compared to what we budgeted for our fixed overhead costs. That's why it's called the fixed overhead spending variance. Let's now move on and calculate the fixed overhead volume variance. For that, we're going to calculate the number on the right, which requires actual units produced, standard activity base per unit, and the standard application rate. We already determined the standard activity base per unit, which is the standard direct labor hours of 4. And we have the standard application rate, which is $12 per direct labor hour. The only additional information we need is the actual units produced, which is 8,300 units. Let's take this information and input it into the formula on the right. 8,300 units multiplied by 4 direct labor hours per unit multiplied by the standard application rate of $12 per direct labor hour, which is equal to $398,400. This is the total fixed overhead applied to the units that we actually produced. In order to determine the fixed overhead volume variance, we have to compare the master budget, the center calculation, to the applied fixed overhead, the calculation we just did. Comparing $384,000 and $398,400, we can see that the difference is $14,400. This is the fixed overhead volume variance. So, is the volume variance favorable, meaning the company did a good job utilizing the fixed capacity at the factory, or is it unfavorable, meaning the company did not utilize the factory as well as the master budget indicated they should have? In order to determine if the fixed overhead volume variance is favorable or unfavorable, we need to look at the only thing that changes between these two calculations, which is the number of units, master budget versus actual production. We can also see this difference in the actual calculation. The center calculation, master budget, uses 8,000 units, and the right calculation, applied fixed overhead, uses 8,300 units. So, the company produced more units than the master budget predicted, 300 additional units. Remember, this is a measure of how effectively the company used their fixed capacity. The more units they produce, the more effectively they've used their facilities. So producing 300 units more than was budgeted is a good thing for the organization, and that means the fixed overhead volume variance is favorable, denoted with an F. Note carefully that determining whether the fixed overhead volume variance is favorable or not is not dependent on the dollar amount of the calculation, but on the actual production versus the master budget expected production. Now that we have both of these variances, we can calculate the total fixed overhead variance, which is the spending variance plus the volume variance. Since the two variances are moving in the opposite direction, we need to take the difference between the variances, deducting the smaller number from the larger number. 26,850 unfavorable less $14,400 favorable is a total fixed overhead variance of $12,450 unfavorable. This means that the unfavorable spending variance was partially offset by the favorable volume variance, but in the end, the unfavorable variance dominates, with the total unfavorable variance of $12,450. The only thing left to do? Determine the possible causes of the variances. Note that significant variances, which may have an effect on the decisions made by management, must always be investigated. The concept of significant is dependent on the individual organization. A variance that's significant for a small organization may be insignificant to a large organization. Each organization must decide on their own measure of significant. Fixed overhead spending variances may be due to an unanticipated price increase of the indirect manufacturing costs, such as factory insurance or the supervisor's salary. Generally, fixed overhead spending variances are the responsibility of the production department. The fixed overhead volume variance may be caused by inefficient use of direct labor or poor maintenance of factory equipment, which causes breakdowns and delays in production. Or it may be that the flow of material through the production process is experiencing bottlenecks, again resulting in a reduction of production. Similar to the fixed overhead spending variance, the fixed overhead volume variances in this case is the responsibility of the production department. However, if the difference between the budget and the actual sales is due to a lack of sales orders, then the sales department, responsible for predicting future sales, would be responsible for explaining the variance. That's it for the fixed overhead variances, spending, volume, and total. Hopefully you found this video valuable for your learning, and as always, thank you so much for watching.